In this edition of Mortgage 101, what is a non-QM loan? If you've heard of conventional FHA, VA, or USDA loans, each of these loan programs have to meet and follow certain lending criteria to be considered a qualified mortgage. They have to meet safer lending standards as described by the Consumer Finance Protection Bureau. Some borrowers don't quite fit in this narrow box. For situations like these, there are other non-qualified mortgage investors and lenders who will make loans to borrowers using loan criteria that's outside of the qualified mortgage guidelines. Because of the characteristics of these loan types, the interest rates and fees are typically higher than what would be available with traditional financing, though not always the case. Some borrowers will use a non-QM loan to get approved to buy what they want and need now, with a target to get their finances in order so they can be in a position to refinance to a traditional loan down the road. What are examples of non-QM loans? Some consumers have significant income that isn't necessarily reflected on their tax returns. In cases like this, we can use their bank statements to analyze their deposit history and calculate their average income that way. Some investors don't show enough income on their tax returns to get approved to buy another rental property, but there's a non-QM program called a DSCR loan, which allows you to qualify based on the projected rental income compared to the projected monthly payment on that new property, and no additional income information is needed to qualify. Some programs will allow you to get approved if you had a foreclosure or bankruptcy that's too recent to be eligible for the other loan programs. Another example is where a business owner might be able to calculate their income not on tax returns but on a profit and loss statement instead. Think of a business owner who's had tremendous growth and profitability through the first 9 months of the year. But a traditional loan program would only be able to look at the previous year's tax return, which wouldn't be as strong and maybe not as indicative of the current and projected earnings. There's too many different programs to cover here, and there are several lenders and outlets that offer this type of financing. A non-QM loan would be a good alternative to a borrower who's having trouble getting a traditional loan and is looking for another way to get approved.